Okay, so some more, again, some of these are blindingly obvious, I think. Factors that will drive residual recovery and the value of an asset in the open market. We've touched on a few of these already this morning in terms of taxation, any regulatory changes or regulatory incentives to do certain things. Cost of energy, or consumables might be an issue. If there's a step change in the performance. Again, if you go to, it's maybe slightly the other way of thinking about it, but if you think about the solar market, people were, rushing into this a few years ago, and what's that worth? I mean, you think that's quite sticky because it sits on somebody's rooftop, probably quite costly to deinstall, and why would anybody take it off there? There's a degradation in performance of the existing cells. There's constant improvement in technology of the photovoltaic cells themselves. So at the end of the day, you're probably asking the question, what's that square meters worth of space, either on a roof or wherever it's situated? What could that economically produce? And that's really your question. And what's the price of energy going to be in the future as well? That's the other consideration. Because if it's just sitting there churning out free money, that's going to drive the value of your sale in place price to the end customer, or renewal conversation that you have with the end client. So it's really assessing each situation and trying to look into the future to say, and that's probably the most complex example that I've come across to try and take a view on. And certainly if there were people taking views on doing 20-year deals, which I have to say we did a few of those at DLL, it's an interesting equation to an interesting risk conversation to get into. Transaction currency, I don't think I need to explain that to you guys. I mean, if you do a deal in local currency or you do it in US dollars, that clearly has an impact. What's the prevailing underlying market for, if it's a globally traded asset? Mm-hmm. If your contractual currency is dollars, you have, you're going to have a dollar position in a few years, and you're going to have a dollar market. So, building in a local currency risk, you're intrinsically potentially have some FX risk, to foreign exchange risk, to at least think about, depending on where your secondary market is. Juan, you wanted to jump in? Or?
No, I think you tackle it perfectly.
I mean, the other aspect related to foreign exchange and currency is obviously inflation. If it's not on the chart, it should be. It is, yeah, bottom right. So, that can help the asset manager if you're in an inflationary environment. And I think we've seen that in a number of markets. So this is the bit that we've kind of talked around, or I've talked a little bit around, as has Juan. This is really the more formulaic approach to setting residual values, and it's a combination of, what do we think the asset's going to be worth? And then what do we think the customer will do? Might be at the end of lease, might be a mid-term event that you're going to trade up a few customers mid-term. You get some assets back early. You'll get some assets that are damaged. That might be a profit opportunity for you as well. Certainly, it's an area, in my experience, again, depending on the asset class, it's an area you can make money on assets that come back, slightly damaged, or things are missing, or again, you can't afford to abuse the customer, but you can reasonably charge a decent amount of money if it doesn't come back in the condition and state you're expecting it to. And then, the last point is really about, what's once you've gone through the probability analysis and said we're going to get 20% sale in place, 5% renewals, 75% return on time, you then end up at a projected level of residual recovery. And then you've got to say to yourselves, based upon the asset class, how comfortable am I with the inherent volatility and the assumptions I've made there? And you put some level of comfort or margin in there. And again, that's this level of safety margin, depends on your internal risk policies, how aggressive you want to be, how much market share you want to go and grab, whether you're in growth mode or consolidation mode, or it's such an important part of your potentially it's such an important part of your value proposition. This does flex, as I said, dependent on where you are in the quarter even. But you should always be very clear what you're targeting as your safety margin and buffer. And just the last comment there. These things, the experienced asset manager will know when he or she, I should have said, excuse me, can be a little bit more aggressive if they have strong return conditions, or they see a scenario where they're convinced the equipment's not going to return on time, or even maybe we come to it later, but just whether you have a semi-annual profile or a quarterly profile or a monthly payment profile. To me, as an asset manager, that plays into my risk appetite, because if a customer misses a notification and he's into a 6-month payment, that's happy days. It gives you at least a strong negotiating position. So what your payment profile also plays into your level of potential risk appetite. And this is excuse me. This tries to summarize a little bit of what goes through an asset manager's mind, if very much. So you've got some kind of hard data-driven aspects here, which are, you may be lucky enough to have some historical data. You may be lucky enough to have some customer-specific historical data. Obviously not when you're setting out, but over time you get to build this history. Doesn't mean that's going to be the case in the future, but it can again help to inform your decision making. We've already talked about these two. Well, in fact, the anticipated customer behaviour, and the further down we go here, that's very much judgment driven. You can have a view on a technology that this is the way it's going to evolve. You can have a view on a brand. That if you take the auto market, that there was a time when the Korean brands were, oh no, we don't like those. I would take the contrarian view that as long as it's a strong counterparty who's serious about developing in a market, that's potentially an asset that may in fact improve in its market perception over time. And you can afford to have, at lower levels of residual investment, a bigger share of that asset in your portfolio. Again, you've got to be mindful all the time of where you think the market's going. And again, to give you an example of that, when I was, again, back in the car leasing days at De Lage Landen, we had a very proactive appetite to go for smaller cars, because we thought, not just the CO2 topic, but the economic argument for smaller vehicles and greener vehicles would make for a more attractive financial return in the longer time. Also, fit very well with the CSR objectives of the bank. Rabobank is an agricultural bank, is a very, CSR is a very important part of its brand perception. So again, that was something we consciously did, and I think not only from a brand perception, it was good business too. So always looking forward, I guess, is the takeaway from that. This is what I promised earlier. This is the kind of approach that you can take based on whether you're really dealing with middle to large ticket business, which would be down in this kind of area, or whether you're dealing with flow business. And there's no rocket science in here. You can take a very simplistic view on we're going to take a matrix approach to setting residuals, and by that I mean you have a table that says for assets X, Y, Z going across the top, at 12 months, 24 months, 36 months, 48 months, you've got a different percentage. And so you have a matrix that you just apply to certain assets that fit within certain criteria. You probably should have, for certain assets, adjustment factors such as levels of usage. So again, in the anything that has wheels should probably have miles or kilometers as one of the variables that it's valid for, and the terms and conditions should then reflect the ability that you can chase the customer for any deviation from what the original expectations were. You can get more sophisticated if you have a regular flow of certain type of assets, and could be IT, it could be cars, could be any line of business. Somebody mentioned forklift trucks earlier in the day. Again, in the past, we built forklift truck calculators that took into account the aspects that would drive the right residual setting based upon the characteristics of those assets, and it made sense because we were getting requests every day, multiple requests every day. So you wanted an efficient way of servicing the customers quickly, getting to the right numbers, hopefully, or best view of the numbers, and having a consistency of approach. So the vendors couldn't turn around and say, hey, you gave me this number today, it's different to what we got 2 weeks ago, why is that? And the dealer environment in particular, I'm sure people will play games and try and cajole people into getting different numbers. So this provides a good control environment and provides consistency in terms of the numbers that are generated and the risk profile that you're building. With regard to the individual residual requests, I think we go into that. Yes?
Can you put some examples on the first approach?
On flow business? Oh, gosh.
Sorry, on the flow?
Oh, you could have that in photocopiers is a great example of that. Mm-hmm. You've got it in typically small ticket leasing environments where the residual has a pricing component. There's not necessarily a big service component. To protect yourself, agriculture is another market.
More like a portfolio approach.
Doesn't have to be. It's typically where you've got consistency of product, you've got a lot of flow. I guess it's more often than not, it's smaller ticket transactions. So it's just, you couldn't afford to have an analyst looking at every deal. So it's a combination of flow and value of transaction that, mandates that you go for this. It needs to be fairly consistent in terms of the asset, I would say, and you need to do some checking of the prices, because if you're taking a fixed percentage and one day you're paying $20,000 for an asset and the next day you're paying $50,000 for the same asset, you need to make sure you're watching that. So the next slide is a bit wordy, so apologies for that in advance. It's it really, again, it's not exhaustive, but it tries to talk through some of the things that you would think about when you're looking at the larger ticket transactions. And I think we've probably covered most of those in terms of the considerations, I think, already.
Entonces, lo que estamos hablando aquí es tal vez de 3 procesos, ¿no? Que muchas organizaciones pueden convivir, ¿no? Hay, digamos, como preguntabas, depende de cuando uno tiene que decir, si uno puede ver todo y aprobar todo y ver qué tipo de cliente, qué tipo de uso, bárbaro, ¿no? Eso es ahí donde uno se asegura de tomar las mejores decisiones. Pero muchas veces el volumen del negocio no lo permite, ¿no? Es por eso que, haciendo el paralelismo con crédito, no sé cuántos de ustedes trabajan con alguna herramienta de scoring, ¿no? Para determinadas transacciones, bueno, ya es imposible estar viendo carpeta por carpeta porque uno termina perdiendo el negocio. Entonces, bueno, de la misma forma, digamos, el establecimiento residual, la cotización residual tiene que pensar en el negocio. Lo primero es el negocio. A ver qué nivel de intervención realmente es requerida. Entonces, a veces uno se basa más en variables y otras veces más en conocimiento, digamos, puntual de la transacción. Tiene mucho que ver con el tamaño de la transacción. Pero es bueno que de la misma forma que ustedes lo establecen en riesgo, que tal vez uno dice, bueno, estas transacciones las voy a analizar con este proceso, estas las voy a analizar con este otro, que en el caso de establecer residuales, creen una política, un proceso que puede, digamos, manejar las distintas situaciones que les presentaba Ian. Podrá ser unas que saldrán por matriz, por un proceso, otras que saldrán tal vez por un calculador. Ahí le están pidiendo que ingrese algún tipo de variables, ¿no? Como si puede ser un scoring. Dice, bueno, ingresamos a leer qué tipo de actividad lleva adelante, cuántos turnos suele utilizar el montacargas, ¿no? Y otras que, bueno, vamos a hacer un análisis, a ver el cliente quién es, ¿no? Cuál suele ser su comportamiento habitual. Esos, si están seriamente en el arrendamiento operativo, sería bueno que esos 3 procedimientos estén establecidos.
Okay, one thing I'd just add to what I already said about the matrix approach, it doesn't need to be a percentage, and it's actually safer in many ways. Mm-hmm. If you're putting a local currency, whatever the local currency value is, and then that takes away the potential risk of having an inflated asset price that's driving a high percentage. So that's, I've seen it work probably in hybrid models as well, where you have a percentage and then the asset can't exceed this price. If it does, then it gets thrown out and is referred to an analyst to look at. And that's this is a little bit around, I suppose the process is around those exceptional requests. So something that doesn't fit in the standard bucket. Typically, again, I'm talking about the larger organizations where you have multiple asset managers. As you maybe saw earlier, when I was at DLL, we had 150 guys in our team worldwide. Not all of them asset managers, some of them remarketing, but we had different levels of analyst, manager, etc., etc. And so we had different levels of delegated authorities. So an asset manager would have you're allowed to do this. Two sign-offs, you could go to this level. And for the very, very large transactions, we had a global asset management committee which I chaired, and so anything above a certain level of exposure or deviation from a standard position would come up for formal approval. That's just, again, that speaks to the governance topic. You need to empower and trust your people and make sure you have the right people who are capable of making the decisions, as far down the organisation as you can. But at a certain point, if they're going to be big concentrations or they're big risk positions, you need to have, a couple of pairs of eyes at least contemplating these topics. And, I don't want to spend too much time talking about impairment because it's a pretty dry topic. But this kind of post-deal auditing and booking, particularly for the larger ticket transactions, that can be part of your impairment process. The larger ticket players will have more regularly, typically monthly, sometimes quarterly or semi-annually, impairment processes to go through the risk positions and look at these positions. There's a little bit about let me go over here, and I can probably explain it with the pointer a bit better. The picture that I've tried to draw here, and it's only indicative, you shouldn't take this as being absolutely accurate, is what I've called behavioural component. This is the aspect of how much do we think the customer's likely to hang on to the asset, or will do something at the middle of the lease, and how that plays into setting the residual. So that's the y-axis, axis I should say. And going across is the intrinsic level of asset volatility. So the example I gave earlier of the semiconductor market, very volatile asset. I mean, it follows the economic cycle, in an inverse pattern pretty much. So when the market's down, it's the market. In a reinforcing way. The asset performance is atrocious. Some are more stable in terms of the asset value. Agricultural equipment's been reasonably stable, not in every market, but it's been, never say never, because all markets are subject to a level of volatility in supply and demand, but people continue to want to eat food, so agriculture has been reasonably stable over the last 10 years. I know there are differences in local markets on that topic, but so I guess the takeaway from here is up here you've got an asset that's very behavioural. There's very little in terms of the asset value that you set your residual upon. Something over here, test and measurement equipment, it's quite a volatile market. There's a level of behaviour to a residual there. So even, I guess before I finish that sentence, I should make one comment. The one thing that you need to understand is whether it's positively reinforcing or negatively reinforcing in the economic cycle. If you get something like IT equipment in a down cycle, people typically don't refresh their fleets. So in that situation, you get the assets tend to extend. Same's true in the healthcare environment. We saw that in 2009 when everything was going bad in terms of asset values, pretty much universally across the world. You saw things like healthcare from an asset management performance performing really well. Same in IT. Customers weren't replacing assets. So when assets reached the end of the lease, they just renewed and made a lot of money. So even though the actual value of the asset was down, you were making the money because it renewed. As I said earlier, that wasn't the case in the example of the aerial platforms and in terms of the trucks. And that's one thing to watch, I guess, as a learning from that is a market that's heavily rental dependent, where you've got a large component within the wider marketplace that's got a big rental fleets or series of rental fleets. The ability to return equipment in a down market can really drive prices down very significantly and very quickly. So anyway, I mean, the main takeaway from this is have your eyes open, understand the markets that you're playing in, understand the secondary markets, understand what's likely to happen in each phase of the economic cycle, and place your investments accordingly. This tries to summarize again and draw the contrasts between the different asset classes, and it's probably very difficult to see at the back, but what we have here, again, it's only directional, it's not specific, but you've got three different asset classes, and it shows going up the y-axis, it shows how much of the residual recovery comes from the different channels, and by channel I mean whether it goes into renewal. So something like office furniture, it's got no value, virtually no value, intrinsic, remarketing value. But, as long as you're not changing offices, people keep hold of desks and other furniture and fittings. So if you have a program like Steelcase, you can make a lot of money just because clients don't refresh the assets. The inverse or the converse, let's say, in cars, it's almost all about the asset value. So understanding what the market price for the asset will be is really, really, really important in the car leasing industry. And again, depending how volatile the local markets are or the channels that you can access to sell, that should govern how aggressive or conservative you want to be on your residual setting. Again, in mature markets for car leasing, the difference between a residual that will win you business and a residual that will mean you get no market share can be as little as $250, depending on where you are in the cycle. So you can imagine how well you have to set your residuals in a market like that. Obviously, that's a very mature, competitive market, and I don't believe that's the case to the same level, at least in many of the Latin American markets. And again, we put the example of laptops up here. What it shows you here is the light blue bar shows you that 40% of your residual recovery might just come from customers keeping hold of the assets for 3 months. It's not outlandish to think that somebody will keep hold of their equipment for 3 months past their initial period of 36 months. A number of customers will, they'll lose them, and typically in that scenario that will result in a buyout, and you can charge a good price typically in that scenario, being again conscious of what I said about not abusing the customer relationship. And as I mentioned earlier, the actual claims that you make around damage or missing components. Again, way back when in the days of Dell, we used to, we had diagnostic software in our remarketing returns centers that would just immediately tell you exactly what was in the box, and if there was a piece of memory had been taken out, you knew that immediately because we had the bill of materials from the captive, well, quasi-captive it was. So we knew exactly what the specification of that equipment should be, and you chase the customers for the missing memory. So is that clear to everybody? Because it is it's the basis of really the residual setting around behavior. Excuse me, around behavioral residual setting. Any questions on that? Okay.
Como conclusión, digamos, de esto es, si vamos a estar en arrendamiento operativo de automotores y no queremos que nos devuelvan los automotores, no estamos claramente vamos a tener un conflicto de intereses, ¿no? Entonces, aquellos que van a hacer leasing operativo de automotores, hay que ocuparse, decir, bueno, lo que tengo que ofrecer al cliente es justamente eso, me van a devolver el auto y tengo que tener el procedimiento establecido para hacer el remarketing, las inspecciones, todo, como decía Ian, sin entrar en conflictos. O sea, claramente siempre diciendo, le estoy prestando el servicio que el cliente quiere, ¿no? Que es cambiar el auto por uno nuevo. Entonces Ian habló de terms and conditions, o sea, cuáles son las condiciones de devolución, ¿no? Cómo ser proactivo sobre esa condición. Y me permito dar un ejemplo que es muy normal, por ejemplo en IT, ¿no? Hablábamos, es muy normal, digamos, ¿qué es lo que una compañía de arrendamiento operativo espera que suceda con un lote de computadoras que está en el cliente? Supuestamente un cliente tiene una computadora, la está utilizando, y está en pleno funcionamiento. Entonces, lo ideal que sucede es que venga alguien, se la cambie y la persona siga operando con su nueva computadora. Para que esto suceda, alguien tiene que haber reconfigurado la máquina que va a ser reemplazada, o sea, ya hay un servicio, pusieron una imagen, ¿no? Entonces tiene que tratar de ser un cambio, como diríamos, seamless, que le dicen, ¿no? Sin conflictos. Ok. ¿Qué suele suceder muchas veces? Digamos, cuando el remarketer recibe las computadoras, a quien nosotros le queremos vender las computadoras, al final recibe un montón de notebooks que el teclado no andan, están rotas, ¿no? Digamos, le faltan piezas, el disco, la pantalla rayada. Claramente, esa computadora no estaba en operación, ¿no? Si Roberto estaba usando una computadora que le faltaba la A, imposible, no la estaba usando. Entonces, ¿no? No podrías haber soportado una hora sin la A, ¿no? Entonces, esa computadora, ¿dónde estaba? Estaba en un depósito. En ese depósito, la persona de IT de la compañía dice, uy, tengo esta computadora, y algo le faltó a otra persona, y bueno, le saco un pedazo a esta y se la pongo a la otra, y así empieza un proceso de destrucción de ese lote. Entonces, cuando llega al final del leasing, digamos, la compañía de leasing recibe un montón de cientos de computadoras todas destrozadas. Bueno, ahí hubo lo que llamamos desidia, ¿no? Una falta de un proceso intermedio, ¿no? Porque nosotros ni le brindamos un servicio al cliente, porque le estábamos cobrando por un material inerte ahí en un depósito, y entramos en un conflicto. Pues le decimos al cliente, no, mirá, me devolviste basura, te tengo que cobrar la computadora como nueva. Pero nunca me habías dicho eso. O sea, nos pusimos en una situación de conflicto, ¿no? Entonces, a quien le van a vender la computadora, decir, no, mira, yo te dije que te iba a comprar esta notebook en $200, pero me acabas de entregar un pedazo de chatarra, no te voy a pagar, te voy a cobrar por deshacerme de la chatarra, ¿no? Entonces, cuando uno ve estos porcentajes, dice, bueno, yo debo actuar sobre eso, pero véanlo como una oportunidad, ¿no? de servir al cliente, porque el cliente claramente lo que quiere es recibir un servicio. Entonces, si nosotros atacamos, como se abrazamos esa oportunidad de prestarle un servicio al cliente, y el cliente lo va a agradecer y va a estar dispuesto a pagarlo.
Okay, we'll move on quickly because I'm just conscious of lunch for everybody. The next slide really talks about the role that a vendor can play, and I won't read through all of these, but I think again, depending on the asset class, it's important to understand where you stand. Some assets are almost impossible to remarket independently if you don't have access to a software key, for instance. Licenses are an important topic in an increasing number of assets. So again, having a relationship with a manufacturer or somebody who can provide that for you, you should be conscious of whether that's an issue or not for the equipment that you're using or financing. And the last point is really just more, again, having a view on what's likely to happen in the industry. I've seen this happen a number of times where you think you've got a really good relationship with a manufacturer and you've got the best remarketing agreement in the world and you've got every single thing covered that you want and you've got a long-term relationship in mind, and then they get bored. And there's even though you might have change of ownership clauses in the language, the reality is they don't see you as an important party anymore. So again, I don't want to be too pessimistic about these things, but it's more just if you're heavily reliant on a third party, just be aware of what could happen. The example of Kodak is not so outlandish, and even successful companies get bought all the time. So just think through what might happen in a change of ownership scenario if you're in a vendor model and where you're setting your residuals based upon a series of assumptions that relies upon their support. And that they can again, provides a great level of comfort. I mean, again, it's probably more in the technology domain, but I think it's true of lots of an increasing number of assets, knowing when your, again, vendor finance model, knowing when the manufacturer is going to introduce a new piece of equipment, what their pricing strategy is going to be, how much margin do they have in the existing equipment, and what are they going to do with that next month or next quarter. Everybody should be interested in keeping asset prices high. It's not always what you see in practice, and again, having as much insight into where the manufacturer is going, both from a technology perspective, but from a pricing and margin perspective, and support. That's an important consideration as well. If somebody had an example many years ago where we were reliant on a partner to do remarketing support in Europe, our legal agreement didn't say that the support had to be taken place in Europe. They closed it and moved it to the US, and completely changed the economics of the situation. And we had some struggles in terms of our net remarketing proceeds when that happened.
If I want, un ejemplo de eso, ¿no? De esa última frase que es tan importante. Voy a hacer un comparativo entre dos fabricantes muy importantes de equipamiento de almacenamiento de data, ¿no? Storage, ¿no? Storage es un tipo de bien que digamos, tiene un comportamiento de fin de contrato muy disímil, depende de qué compañía, digamos, sea el fabricante. ¿Por qué? Porque, hablando de dos líderes, tienen una estrategia de mercado totalmente distinta. Entonces, compañía A uno firma un contrato de arrendamiento operativo con esa compañía. La compañía A, por norma corporativa, tiene que garantizarle al cliente que le va a mantener estable el contrato de mantenimiento por lo menos 5 años. O sea, llego al mes 36. Ese cliente, si quiere seguir con ese equipamiento, sabe que le van a seguir cobrando la mismo, canon de mantenimiento del software y todo, o menos, pero no le van a incrementar el precio. Entonces, con la compañía A hay una probabilidad de renovación bastante buena. El equipo está en el lugar, está buen performance, no se le, dificulta el renovar, ceteris paribus, sigue adelante. Compañía B, su estrategia es más vender equipamiento. Entonces, para producir ese efecto, lo que hace es al mes 36, automáticamente aumenta un 50% el canon de mantenimiento. Entonces, un cliente estaba al mes 36 y pagaba 100. Si quiere renovar el contrato de leasing con ustedes, estamos hablando de compañías corporativas, no va a renovar el contrato de mantenimiento con el vendor. Automáticamente de 100 se le fue a 150. Probablemente cambie. Entonces, alteró la probabilidad de devolución. Es más probable con la compañía B que te devuelva el equipo al final del contrato. Y estoy hablando de la misma tecnología. Por eso que es tan importante qué tan metidos estemos en la estrategia de reventa, de venta de nuestros vendors.
¿Qué mecanismos reconoces o existen en el mercado para medir ese valor en riesgo del vendor cuando yo confío en el vendor, el residual? ¿Cómo transformo un montón de asuntos cualitativos que están aquí descritos en un número, sobre todo para aquellos quienes estamos desde una entidad bancarizada, porque al final eso lo tenemos que traducir en unos límites que nos determinen hasta dónde asumimos cierto riesgo con un vendor determinado?
I think maybe this, if you want hard numbers, that you can go to the bank and say, this is our level of exposure. What you can do is, paint different scenarios. And I've been asked to do this actually a number of times, where we had either concerns over the credit quality of big exposures, so vendors where we had big exposures and they were in bad shape, let's say. And also in cases where we knew there were going to be changes of ownership, and again, big exposures, the bank got nervous and said, what are we on the hook for? You then take a view as to, what does it look like with the vendor support? What does it look like without the vendor support? So what would the market, so if you were just broking something with no support at all? Those are live examples where we cranked the numbers and really at a very senior level in the bank, because there were material exposures, they were evaluated in terms of really the way, if you're asking the question in terms of front-end processes and governance and control. Again, we would be quite explicit in the wind back a second. For each every year at least, depending on the market, we would have a governance environment where we would look at every single vendor, and some of them more often than that. And we would, if you like, play these scenarios through and say, what happens if, this disappears, this goes away? How reliant are we on them for a positive outcome? And the truth is, it's hard to be. You can't be precise. You can just be directionally right, I suppose, and hope to win more times than not. Sometimes you get it wrong. That's the nature of life. But that's where, if you went back to that picture of the judgment versus fact-driven environment, that's definitely at the lower end, and it's a judgment. An informed judgment based upon the facts, and as much as you can by going to the market and saying, okay, what does it look like without vendor support, or what would it look like with a tier 2 vendor, in terms of what would that look like to sell? If you're completely on the hook for your residual realization through a third party, you might just say, I don't want to play that risk. And I'd rather play in a liquid commodity environment where I don't have vendor risk. And that might be a good decision. The intention here is not to say that's the right model to follow, that's not the right model to follow. It's more just to say these are the things to address. And it's a good question, because it's very hard to say it's precisely that amount of money. But what you can do is go through that thought process of upfront. What does it look like? And if things are changing, and it's why you should have a regular vendor risk review process, you should be playing those scenarios. How are we comfortable having this level of exposure with this player? And it should govern your asset risk appetite. That should be part of your decision-making framework that says, how much are we exposed here as a business? And particularly in a banking environment, it's something that you don't see in every institution by any means. I would be, painting a picture that's not true. The more advanced organisations ask these questions, rightly so, and expect processes and governance that addresses that.
The line of assets or brands or kind of assets taking or not taking residual values. I mean, it's supposed we are all only finance leases companies, or we are not offering residual value. We haven't an offer of residual value lease, but we already are taking legal, operational, obsolescence, contract, all the other risks that you mentioned. So shouldn't we start analyzing our position in this brand? Probably we are an important player in the market. it's not in operating lease, but in finance lease with this vendor. So before analyzing if we are willing to take or not residual value in some kind of assets, we should know first what is our market share or market position in finance lease. It's a question, or is I don't know if it's a question.
No, I think I know that. I can see what you're asking, and you know, surely if you have a very heavy exposure in a certain market area, finance lease or otherwise, that's absolutely something that would keep me awake at night as a credit officer or chief risk officer. You know, I would want to know how exposed are we to, you know, film and television industry, to go to Juan's example from earlier. You know, if you're heavily in there and there's a paradigm shift, you know, and lots of companies are going to fail, that's something I would be thinking about, and particularly if the underlying assets are not particularly strong. So, I mean, you know, finance lease or operating lease, yeah, I think you should be constantly looking at which industries you're participating in, and the same from a vendor risk perspective too. Well, you know, again, going back to former lives in a number of other companies I've worked in and consulted to, the vendor risk around credit support is an important consideration.
What I mean is not only from the customer perspective, I mean, not the industry, but the vendor, but the type of equipment. If I already have 25% of my portfolio in construction equipment, so probably I have a story related with repossessing or dealing with that kind of equipment, I'd be closer to trying to analyze, take residual values in construction rather than, I don't know.
I think that's logical. If you've got a familiarity and competence and you've got some internal data that says in the event of default, this is what happens, and we have some remarketing channels already developed, it's an easier step to make to those assets. I guess the only point I was trying to make was, you know, when you're doing your risk management, you should be looking at your whole exposure and how much support you're relying on from the vendors and how much exposure you've got to a given industry. But I agree with you. You're right. You know, this slide again. You can look at this in Spanish and at your leisure. But this just goes through some of the contractual considerations that you know, good practices to have in your documentation, your end customer documentation. So again, we've talked about a lot of these already, I think.
This is a good checklist.
Yeah, it's, you know, again, it's not everything that should be there, but it's the lion's share of them, I would say. You know, one thing that people often don't, not often, but sometimes people get caught because they have what's called a fixed term agreement, and it doesn't automatically allow you to renew the contract. I've seen that a number of times, and it's a bad structure. And I would avoid that if you can. I mean, to have to go back to the customer and not be able to maintain the billing cycle is something to avoid if at all possible. What else have we got on here? You know, one of the items there is, you know, the ability and the right to have to go and inspect prior to the end of lease, and even have customers go and inspect equipment. That's actually a really important clause to have in certain asset classes, to actually see something operational and to have buyers physically be able to see that it's working has an enormous amount of value. And, you know, as opposed to just even a third-party valuer or inspector's opinion, to actually have customers in and having a look at a piece of equipment whilst it's still in situ and is actually something to think about. And that, you know, industrial equipment is an obvious one that comes to mind. Healthcare equipment is similar, and that's something that you should have in your standard terms and conditions. Everything else, I think just because it's maybe not obvious to everybody, the language here, use of all but not less than all return language. I don't know whether that means anything to everybody, but what it really means or refers to It's very common in the IT domain, particularly in big fleets, to mandate that a client should return all the equipment, and if they can't, you then have the right to bill them for the whole schedule. You know, typically you will give ground on that and you'll negotiate, but it puts you in a very strong negotiating position to start with. You know, the big corporates are well aware of this, and they'll not allow you to have that as language in the documents. But where you can, you should have it, because you know there are operational costs associated with part terminating contracts. So I think it's arguable, and it puts you in a good negotiating position, and that's what the end of lease is all about. It's, you know, one, I'll talk about this afternoon. It's not about really beating the customer up. It's saying, hey, listen, this is what the contract looks like. You know, you're not in a good spot because you failed to notify us, and by the way, you can't return everything. We're going to be friendly and cut you a deal, and then everybody walks away happy. And it's a really, depending on the assets, it's a really, really important area to get right. Not a difficult area to get right, but it is worth having people who've been through this to at least advise, or get people who've lived this and done that role somewhere else, because they can drive a lot of income and they can keep your customers really happy. But you'll get to that this afternoon, Juan, I think. Okay, this slide is it's lots of words, I'm afraid, but it really just tries to take 4 examples. It talks about, you know, what you might think about at the front end of the lease when you're setting the residuals. Talks a little bit around how you might manage the position in the middle of the lease, and then there's some guidelines around typically how end of lease works for those different asset classes. Not true for every single asset within those broad headings. There are obviously exceptions, but if people have got questions, just shout up if it doesn't make sense, rather than going through every one of these. But it really just talks to the point I was making early in the day about, do you take a passive mid-term approach? So don't do a lot of activity and just pray that it goes to the end of lease and then it renews. And there are asset classes like that. You know, do you take a proactive approach to driving sales and to really keeping the customers very, very happy? And I would argue that, you know, there should be a good balance of that you should always be trying to be on the front foot to drive vendor retention and customer retention. I mean, it's a short-term game if all you're into is just trying to make money out of customers at the end of lease. You know, companies do that, they can make a lot of money, and then they can't operate in the market for probably ever again, because they just get a very bad reputation. And that reputation travels very, very quickly. So if people start to abuse customers at the end of lease, people talk, and then other companies get organised and start returning equipment on time. It's a dangerous game, and not one I would advocate.
Bravo.